Good morning, afternoon, or whenever you're finding us. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is January 15th, 2026. I'm Susie.
And I'm Miro.
And today we are tackling the absolute juggernaut that is TSMC. Their Q4 2025 report just dropped, and honestly, it feels like they're operating in a completely different reality than the rest of the semi world. Just massive numbers, Miro.
Yeah, massive is the right word. Look, usually I start with revenue, but I have to start with the margins this time because they are frankly ridiculous. Gross margin came in at 62.3%. Just for context, they guided for 59% just a few months ago. So they beat the high end of their own guidance by a lot.
62%. That is, that is software company territory, not a foundry that melts sand.
Yeah, it defies physics. Yeah. But to hit the headline numbers first, revenue was $33.7 billion US dollars, up almost 6% quarter over quarter. SPS came in at 19.50 new Taiwan dollars, up almost 12% from Q3. So top line beat, bottom line beat, margins exploded.
And the market liked it.
The market loved it. It was a choppy quarter leading up to this, but after the print, the stock gapped up. Closed the day around 349, up about 7%. People were worried about an air pocket in AI demand, and TSMC basically just said, what air pocket?
Right. And before we get too swept away by the green arrows, quick reminder that Miro and I are just two friends chatting. This isn't financial advice. Do your own homework. Please don't sue us. But Miro, you mentioned demand. There was this moment on the call. Did you catch the quote from CC Wei about the hyperscalers?
Oh, I know exactly which one you mean.
It was hilarious. Someone asked if he was worried about the AI bubble bursting, and he just goes, I double-checked their financial status. They are very rich. Just blunt, like I checked their bank accounts. The check will clear.
It's the ultimate due diligence. Are you solvent? Yes, okay, here are your wafers. But look, that quote actually matters because it underpins the biggest number in this whole report. And this is the one that actually shocked me. Everyone was expecting CapEx to be maybe 45, 48 billion for 2026.
Right.
They guided for 52 to 56 billion dollars. 56 billion. That is not a company worried about a bubble. That is a company building infrastructure for a decade.
That is a staggering amount of money. It's like they're putting 50 billion chips on the table and daring anyone to bet against the supercycle. And it's mostly high-performance computing driving this, right?
Yeah. HPC is now 55% of their revenue. Smartphones grew a bit too, up 11% because of seasonality. But let's be real. This is the NVIDIA and AI show. Everything else is just noise. Actually, speaking of noise, they even confirmed they bought more land in Arizona for a fourth fab. Remember when Arizona was the disaster narrative? Now they're expanding it.
It really feels like the narrative shifted from TSMC is struggling with geography to TSMC owns the geography. So we have record margins, infinite CapEx, and a CEO who says his customers were too rich to fail, which usually makes me nervous.
It should. When margins hit 62%, the only place to go is usually down. Or your customers start rebelling. But I don't see anyone rebelling yet.
Well, let's find out why. All right, let's dig into what those numbers actually mean.
Rebelling? Susie, who exactly is going to rebel? That's the brutal reality of this report. When you're the only gas station for 1,000 miles, nobody complains about the price of fuel. They just thank you for being open.
Okay, fair point. It's a monopoly in everything but name.
Exactly. And here is the part that breaks my brain a little bit. We just said 62% gross margin was a blowout, right?
Mm-hmm.
Well, hold on to your coffee. Because for Q1, the quarter we are in right now, they guided for 63 to 65%.
Wait, higher? even with all the overseas fabs spinning up? I thought those were supposed to be money pits.
They are. That's the crazy part. The Arizona and Kumamoto fabs are actively diluting their margins by 2 or 3 percentage points. And yet, the core machine in Taiwan is running so hot, so efficiently, it eats that cost and keeps climbing.
But here's the kicker. The CFO admitted that their price hikes were just enough to cover inflation.
So if the extra margin isn't coming from price gouging, where's it coming from? Pure utilization. They are running those gigafabs at absolute red line. It's distinct from pricing power. It's operational leverage on a scale we haven't seen in semi-manufacturing ever.
It sounds like they're practically printing money on the wafers at this point. But Miro, you're the one who always talks about bottlenecks. Surely the physical world has to intervene somewhere.
Everyone's talking about the power grid running out of juice for these AI data centers. That was the most fascinating moment of the call for me. C.C. Wei basically threw cold water on the whole energy crisis narrative.
Really? How?
He said he asked his customers, the hyperscalers, about the power shortage. And they told him point blank, "We planned the power 5 years ago. Don't listen to the noise. The bottleneck is you."
The bottleneck is you. That's strangely personal.
It is. He literally said they told him to ignore everything else and just give them more silicon. It clarifies the whole picture. The grid isn't the choke point yet. TSMC is the choke point. That's why they can guide for $65 billion in revenue next year. They know exactly where the constraint is because they are the constraint.
So they have the leverage, they have the margins, and they have the customers begging for product. Okay, Mr. Skeptic, where's the gravity? What brings this back to Earth?
Physics, and specifically the next node. They warned that when N2, the 2-nanometer tech, starts ramping in the second half of 2026, it's going to hit margins hard. We're talking 2 to 3% drag.
The classic new tech costs money problem.
Right. It's the cycle. They milk the current generation. N3 is a cash cow now, but to stay ahead, they have to eat the startup costs for the next one. So looking at that 65% guidance, I think we might be staring at the peak. This might be as good as it gets before the N2 bill comes due.
That's a sobering thought. We're celebrating the summit right before the descent. So yeah, let's step back for a second and think about what all this means going forward.
Yeah, look, I wouldn't call it a descent just yet. I'd call it a high-stakes poker game where TSMC just pushed $56 billion into the pot.
That CapEx number again. It really is the anchor of the whole story, isn't it?
It is, because you don't spend 50+ billion unless you are absolutely certain that this AI supercycle has legs for another 5 years. CC, we literally said AI demand looks endless. That is a terrifying word for a CEO to use.
Endless. It sounds more like a religious prophecy than a demand forecast.
Right. But here is the reality check. Their entire outlook, that 30% revenue growth for 2026, it all rests on one thesis, that the hyperscalers stay rich and keep spending.
So TSMC is basically a leveraged bet on Google and Meta and Microsoft not blinking.
Precisely. TSMC is the toll booth. As long as the cars keep driving through, they get paid. But if those rich customers suddenly decide the ROI isn't there, then TSMC is left with a lot of expensive concrete in the Arizona desert.
That's the worry. Though for now, the cars are lined up around the block. So what are you watching for in Q1, aside from the margin tightrope?
I'm watching the execution. Spending $50 billion efficiently is actually really hard. I want to see if they can actually deploy that capital without breaking their own efficiency metrics. And obviously, I'm watching to see if that 65% margin guidance holds up or if the N2 costs start biting earlier than they admit.
Physics versus finance again.
Always.
Well, it feels like we're watching history in real time, one silicon wafer at a time. All right, let's close this out. Before we sign off, I want to take a moment to pull back the curtain a little bit. Earnings Unscripted is an experiment. It's a project by a small team of enthusiasts exploring a frontier of AI and how it can be used to actually enrich us. This entire episode was created by a team of AI agents working together. From the research analyst who dug up those CapEx numbers, to the scriptwriter shaping our dialogue, to a QA specialist fact-checking the guidance, and finally us, the hosts. The goal is to deliver high-quality, up-to-date information that would hardly be possible otherwise, and to do it in a way that feels human. We're learning as we go, so we'd love to hear what you think. If you have questions or comments, reach out at earningsunscripted@datamadness.ca or follow us on X.
Look, thanks for listening. See you after the next call.